Hey Squad, welcome to another lesson from Lesson Up Squad. And today we'll be doing the differences between accrual income and accrual expenses, prepaid expenses, and deferred income. Today we will be learning the most important question: why do we need to adjust, the important definition, and easy steps on how to deal with them. Alright, so the most important question to always ask is, why am I doing this? So why do we need to do these accruals, prepaid expenses, and income received in advance journals? And income received in advance is also known as deferred income. So you can use either of the terms. I think at school level, you're using income received in advance. Financial statements are always prepared for 12 months. If you have never seen a full set of financial statement, chat to me or ask somebody to help you look for a set of financial statements on the website. It's very important to see what you're working with. It will help you remember better. Alright, so as I said, financial statements are prepared for 12 months. There are some exceptions in the Companies Act. However, you may not need to know them for now. Every company has its own 12 months, right? You will see in your questions some companies start from March to Feb. Other companies start from Jan to December. Some companies start from August to July. None of them are wrong. As long as it's 12 months, it would be correct. And every company has its own 12 months. Be mindful that accounting works on a matching and accrual system. What that means is that it records everything that happens in the year. It must be recorded in that same year. You cannot record something that happened last year in this year, or something that's happening for the future in this year. You need to match your income and expenses to the year. So your 12 months income statement, specifically your income statement, must tell you a story of 12 months. Your income statement cannot tell a story of more than 12 months. That is why we adjust. But what happens to that extra money that you received or paid? Because I'm telling you, you can't put it in your income statement. So what do you do with it? Do you just leave it? Do you just, I don't know, throw it away? Do you actually do something with it? The right answer is we actually adjust for it. And we adjust for it in the names of accrual, prepaid expenses, and income received in advance. So what we do is we take it out of our income statement and we create new accounts in the balance sheet. So all these accounts are in the balance sheet and we record it in those balance sheet accounts. Let us look at some important definitions related to this section. I know a lot of you struggle with these definitions, so I would ask you today to please take 10 minutes to learn and understand these definitions. It would make the rest of your accrual and prepaid expense section very much easier. Okay, let's have a quick look at the words itself before we even look at the definition. Accrual expense and accrual income. The word accrual means the absence of cash. So this is something that is happening without cash. Prepaid expenses means before. So the word pre is before. It means before, right? Prepaid. You've paid before these expenses. Income received in advance is income received in advance. It literally means what it says. Let's look at the definitions. Accrual expenses. Remember, accrual means absence of cash. So it relates to you not having paid or received cash. No cash is involved in the situation. So it's expenses you still have to pay for the year, but you have not yet paid, but they are for this year. And therefore it is a liability. You still owe it for this year. Prepaid expenses are expenses you have paid before their time. So therefore, these are an asset. Accrual income, once again, is the absence of cash. So income you have not received, but it is due from customers for this year. Therefore, it is an asset. Income you have received in advance. This is for work that you will only complete next year. but you've already received your money. A good example of income received in advance would be a bakery. You would always have to pay a deposit for your cake to be done before you actually receive your cake. That is known as income received in advance, and that is a liability. Let us look at now at the formula that will help us solve all these accrual, prepaid, and income received in advance adjustments. The formula is as such. The amount you are apportioning, multiply it by the number of months you want, divided by the number of months you have. So take a minute, pause this video, and learn this. Number of months I want over number of months I have. So what I want over what I have. What I want over what I have. Learn this and then continue the video. By now you must be very familiar with how I'm trying to do things. I usually give you steps and then we apply those steps. So if you can remember these 4 easy steps, you will not have an issue with accrual, prepaid, or income received in advance in future. Number 1, identify the year-end period. I always say this is very important to do. If you've identified your year-end period, you would know which months you are working with. Number 2, determine for how many months the expense was paid for. Number 3, apply the formula that we were talking about in the previous slide. Number 4, subtract the total amount minus the amount that you calculated in step 3 will give you the extra portion that you've paid for your prepaid expenses. Alright, let's now apply the formula that we all just spoke about. Before we do that, also let's read the question very carefully. The question shows us 5,200 Rand insurance expense, and then it says adjustment. Insurance was paid for March 2009. That tells you you've paid for an expense. Therefore, there's cash involved, so it can't be accrual income or accrual expense. Can it be income received in advance? No, because you are not receiving any income here. Therefore, the only option left is prepaid expenses. Here I've highlighted the year-end period. It's very important to know the year-end period so you know what you're working with. I also like to draw a timeline. Step number 2 was to count the number of months for which the expense was paid. The expense was paid for March 2009. My year ends on the 28th February 2009. So I've paid expenses for the full 12 months plus the 1 month of March, equal to 13 months. Step number 3, let's apply the formula. Remember, it's what you want over what you have. So the amount we are apportioning is 5,200. What do we want? We want only 12 months of expenses. What do we have? We've got 13 months of expenses. Remember, we've calculated 13 here. That equals to us 4,800. That is the amount that should be for 12 months. So what is the portion of the prepaid expenses? To calculate that, you would just take 5,200 minus the 4,800. The balance of 400 is what should be going into your prepaid expense account. Let us now look at the impact on your T account. If you're unsure how to debit and credit, watch the video on how to debit and credit and I will link it. I use the dealer rule. Many of you have told me other rules and you're more than welcome to use any of those. Alright, back to our example. Remember we said that you paid too much expenses, but your financial statement, your income statement can only tell a story of 12 months. So now you've paid too much, so you're going to have to remove that portion. I just showed you how to calculate that amount. Here is your insurance expense account. Our total insurance expense is on the debit side, 5,200. The dealer rule, expenses go on the debit side. But now you have to decrease your expense so that you only have 12 months in it. We would decrease it by doing a credit in your prepaid expense account of 400 Rand. In your prepaid expense account, you would bring the 400 Rand. So basically, you've now adjusted your insurance expense in your income statement and you've taken it to your balance sheet account. Let's look at another quick example. In this example, we will be looking at rent expense and advertising. Let's first do advertising. Let's determine the year end. Year end is the 28th February 2008. Number 2, how many months have you paid the expense for? 3 months. This is already given to us in the question. Number 3, let us now apply the formula. The amount you are trying to apportion is 4,500. What do you want? You only want 2 months. You only want January and February. March only comes after year end. Therefore, what you want is 2 months. What you have is 3 months. That gives you 3,000. Number 4. 4,500 minus the 3,000 gives you 1,500, which represents the amount you have prepaid. Rent. Let's apply the formula again. Determine the year end. The year end is 28 February 2008. In this question, they tell you the building is rented at 2,000 Rand per month. They don't tell you for how many months they've paid. However, they tell you in the income statement they paid 26,000, and if your rent is 2,000 Rand per month, you have actually paid rent for 13 months. Let's apply the formula. 26,000 times, what do you want? You want 12 months. Divide that by, what do you have? You've got 13 months, giving you a total of 24,000. To calculate your prepaid portion, you would take your 26,000 minus your 24,000 to give you your 2,000 Rand prepaid. This shows you that the 4 steps that we've just talked about can work with any example. Alright, we're now going to do the same thing with accrued income. Accrued income is income you have not received, but it is due from customer for this year. We use the same 4 steps to be able to calculate what your accrued income portion is. Let us now apply the steps that we've just spoken about. Number 1, identify the year-end period. Before I identify the year-end period, let's quickly read the question. It says rent income for 28 February 2002 is 12,210. Under adjustment, it says rent for February has not yet been received. There is something you have not received. Absence of cash. Therefore, it can only be an accrual. Can it be an accrual income or an accrual expense? It can only be an accrual income because in this case, you have not received money. It's an income to you. So therefore, this is an accrual income. I've already identified the year-end periods. That was step number 1. Step number 2 is to count the number of months for which income is received for. Right? Here they tell you that the rent for February was not received. Therefore, this amount is only for 11 months because our total year is 12 months. Step number 3, let's apply the formula. It's what you want over what you have. So, 12,210 is the amount you are portioning times what do you want? You want the expense for 12 months. What do you have? You only have expenses for 11 months. That gives you a total of 13,320. What is the accrual income portion that you still have to record? You take the 13,320 minus the 12,210 and you get 1,110. This is your accrual income portion. We will now look at the impact on the GL. So in your ledgers, which is your T account, I would draw my T account for rental income. Remember, your income that has not been received. Therefore, you have to record it in your income statement. Therefore, you have to increase your rental income. I've got a total of 12,210 on the credit side because it is a rental income. I now take my accrued income 11,110 and that is your total portion that you've calculated in the previous slide. The 12,210 and the 11,110 will give you your total rental income for the year. Let's have a quick look at another example. This example relates to interest on fixed deposit for the 28th February 660. The adjustment is that 8,000 Rand was invested on 1st March 2011 at 11% interest per annum Payable quarterly. The interest for the last quarter has not been received. Here you can see that you did not receive anything. You did not receive the cash, and therefore it is absence of cash, which means it is an accrual income. Let us quickly go through the steps. Step number 1, identify the year end. We've identified that 28 February 2012 is the year end. Step number 2, identify for how many months is the amount already given. So here they've told us that the interest for the last quarter has not been received. Therefore, this amount only represents 9 months. So remember, there's 4 quarters in a year. Each quarter has 3 months. So 3, 6, 9. 9 months is given. Step number 3, take the amount you're apportioning and apply the formula. What you want over what you have. So you've got 660. Times it by how many months do you want? You want 12 full months. And how many months do you have? You've got 9 months. That gives you 880. You can say 880 minus 660 equals to 220 accrual. So in step number 4, it's usually the bigger amount minus the smaller amount, which will give you your accrual portion. On this side, I've explained the impact on the GL account. You could go through these. You can also calculate it using a different way. However, I prefer the step method. Accrued expenses works in a very similar way. We use the same 4 steps to determine our answer. Number 1, let us identify the year-end period. The year-end is 28 February 2002. Let us also read the question. It says rent for February has not yet been paid. Right? So there's an absence of cash again. But can this be accrual income? No, because it's not income you haven't received, it's expenses you haven't paid. Therefore, it is accrued expenses. Number 2, count the number of months for which expense was not paid. In this question, you can see it was not paid for February, which is 1 month before your year end. Number 3, let us apply the formula. The amount that you are apportioning over the number of months you want over what you have. So the amount that we are apportioning is 12210. What do you want? You want expenses for 12 months. What do you have? You have expenses for 11 months. 12210 is 11 months. That gives you a total expense of 13320. What is your accrual expense portion? You take the bigger value, which is your 13320, minus 12210 to get 1110. Let us look at the impact on general ledgers. Here you've got your rent expense. Remember, it's expense you have not completely paid. So your rent expense must increase. You only paid for 11 months, but your year is for 12 months. Therefore, you have to increase your rental expense for the 1 month. This is the 1110 that we calculated as part of our accrued expenses. Remember, accrued expense is a liability, and therefore it would go on the credit side. Income received in advance is calculated in a similar way. The same 4 easy steps are used. Let us now look at the impacts on our general ledger, which is your T account. Remember, we've received income in advance, right? So therefore, you need to actually reduce the amount of income you've received. Here we've got the total income of 18,200, and then you will see on the debit side we've got the 1,400 that I've calculated in the previous slide. This is a liability. Therefore, it will be put onto the credit side in the income received in advance account. So guys, let's quickly revise on what we've learned today. We have learned how to distinguish between accrued income expenses and prepaid expenses and income received in advance, and one formula that will work for everything. Remember, what you want over what you have. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.